Hello and welcome to the Goldman Sachs Weekend Macro Call. It's Mark Wilson speaking. I'll be your host for the call. I'm also going to be joined by my colleague, Leah Larson from our investment banking division. Given how busy, volatile and unpredictable markets have been, we're going to have a slightly different lineup this weekend. We're going to be joined by Anthony Gutman, our co-chief executive officer of Goldman Sachs International and co-head of investment banking, who's going to give us some perspectives from the corporate sector and from our investment banking business around the impact of recent policy volatility on our corporate clients. We're then going to go around the world the other way to which we usually go, but we're going to begin in Asia with Sun Lu, our senior Asia macro strategist, and then to Europe with Filippo Tadai from our European economics team, before then hitting the US, and we're going to have Alec Phillips, our chief US political economist, and David Miracle, our chief US economist, talking on tariffs, on the impact on our forecast changes across both economics and strategy, and how the recent policy shifts and the policy volatility has impacted our outlook. We're then going to bring in Peter Oppenheimer, our chief global equity strategist, to discuss how we're thinking about the outlook for equities and for risk markets. And we're going to follow that with Rich Pravorovsky, our head of European equity trading, who's going to talk about risk views across the trading floors. As always, before we begin, could I just remind everyone that this call is for clients of Goldman Sachs only. If anyone else is on the line now, especially members of the press, please could I ask you to leave. And with that, I'll hand over to Leah.
Thanks, Mark. Just a reminder that I'm on the private side of the firm. I won't be sharing any MNPI, and I'm not soliciting or recommending that any investors take any action. Also note that the views expressed by my guests are theirs and not the views of investment banking. And with that, it's my pleasure to welcome Anthony Gutman onto the call. Anthony is our co-chief executive officer of Goldman Sachs International and our global head of investment banking. Anthony, thanks for joining us. Clearly a huge week in the world. I'd love for you to just walk through what are you hearing from clients, what are you discussing with them, and how are we trying to help them?
Yeah, sure. It's a pleasure to join you. So look, I'd say a few immediate reactions. The first one that won't be lost on anyone is obviously, business leaders are likening this to what happened in the early days of the COVID crisis. And in many cases, it's quite similar. In other cases, it's quite different. The similarities are there's clearly a lack of clarity as to, scenarios here and where this goes from here. There's also, an immediacy to it and a shock to the system. There's obviously a lot less of a human element to it. But I'd say the other really big difference is, unlike COVID, this is hitting different sectors in very different ways. And I think each industry, each subsector, by the way, each region is going to need to deploy a different playbook. If you're sitting, in auto, it's very different to sitting in pharma. Or if you're sitting in, Asia, it's very different to sitting in the US. It's a statement of the obvious, but it's interesting how corporates are thinking about this relative to COVID. I would say the other dynamic is, unlike during COVID, and by the way, many other crises we've been in, where really there was a sense of alignment in how do we get back to the world as normal, i.e. the world that predated the crisis. There's obviously a big preoccupation here with what is the new normal, and is this a reset of the fundamental global order? And that's a discussion for another day, but it just is creating more complexity as to how people solve for, addressing this crisis. I would say, overall, by the way, as an aside, corporate sentiment is, concerned, but it's not panicked. And, I think there's a lot of very thoughtful consideration going on at board level and at executive level. What are the big things that we're trying to help corporates think through and obviously are relevant to them as they navigate through this? Obviously, right now, this is happening coincidental with the Q1 earnings season. And so we're starting to see the very first people report Q1 earnings. Generally speaking, you won't be surprised to hear there's not going to be a much focus on how Q1 earnings have played. There's going to be a huge focus on the messaging around outlook and around guidance. And I think this may be one of the most unique reporting periods we've had since COVID. Unsurprisingly, there's going to be an abundance of caution in these outlook statements. That's to state the obvious. What's going to be more interesting and more important is, how corporates seek to guide in this type of environment. And that will have forensic focus from, the buy side and the sell side. We're seeing a range of different views on this. Some obviously are seeking to just withdraw guidance altogether. That is perfectly legitimate, albeit obviously a lot less helpful to the market. There are others who we are spending time with who are really trying to work out how they maintain some form of guidance, but adjusting it in light of the circumstances. And that's obviously something that the market would prefer as it seeks to grapple with, how to do some modeling of, forward projections for these businesses. And so a combination of giving some context, giving some facts while maintaining caution is probably the optimal scenario here to the extent that it's possible. What does that really mean? And I think it's important to everyone, who listens to this call, because there's two dynamics to it. One is, what is the first order impact of tariffs? And then the second element of it is, what is the broader sensitivity of any business to the weakening macro that will come from these tariffs? On the first order impact, people really, spending time on what is the impact on cost of goods sold, what are the mitigating actions you can take? Can you reshore where that's appropriate? Are there other lower tariff locations that you can move business to? And of course, how can you absorb the short-term, hit? Are you going to take it through, margin pressure, or are you going to try and pass prices through to customers? And therefore, of course, there's a discussion around the degree of elasticity of demand. I think the second point, which probably is going to be more consequential and relevant here, is, how much of a lag will there be between the hit to the overall macro environment and the hit to your business? Will it be coincidental, or is there a longer lag? And obviously, it depends what type of business you're in. If you're in a subscription-driven business or a more sort of durable earnings business, that's one thing. If you're obviously in a retail or consumer-facing business, it could be quite immediate. But I think the link to that, the focus on a commitment to protecting margins or cash flow or earnings or other key financial KPIs is obviously what the market is going to look to, and your ability to do so. Overall, the biggest debate here will be a desire, I shouldn't say debate, but will be a desire for clarity as to what are the different scenarios and what are the ranges of outcomes depending on those scenarios. And I appreciate that's something that's very hard to do, as we're only days rather than weeks or months into this. But I think with the passage of time, in the same way as we saw on COVID, people really want to see, some scenario planning and some capacity to explain different scenarios, what the financial impact of those are. Beyond that, which I think is really core right now in terms of people's focus, i.e., guidance dealing with Q1, there are obviously 3 or 4 other big things that I'd mention. The first big one is balance sheet. Clearly, actually, we come into this situation with balance sheets in the private sector largely in good shape, and therefore we're not seeing a huge amount of stress in the system. But there are some subsectors across different industries where there will be liquidity issues over time. By the way, linked to that, one of the things that is getting less focus but is important is the working capital considerations of tariffs and the potential mismatch between the timing of tariff payments and the timing of receivables in companies. And that is something that, may cause more issues than I think people realize. There's obviously also a big focus on hedging. There's a big focus on currency volatility. So balance sheet and, fiscal planning, one big thing. Supply chain disruption. And what I mean by that just is the more indirect effects of what we're hearing around congestion at the US borders and what that means for inventory and stocking. Big focus at the moment. We'll see how that plays. A third area is geopolitics, to state the obvious. If you're a multinational operating across the world, it's a minefield of stakeholders that you've got to engage with, and how you engage with these different governments across the world, all of whom have, vested interests here, is something that I think is occupying the minds of a lot of chief executives, and indeed what you choose to say or not say on the public record. And then finally, obviously M&A. And M&A is clearly key here. The M&A goes both ways. Firstly, on the defense, with weakened share prices, what's the risk of bid activity? We still think that's relatively low, but there's no question the private equity community is looking at this dislocation in share prices and wondering if it's an opportunity, to consider bids. And then on the front foot, degree to which people want to do M&A, I think it's early for that. I think until we can shape out more precision around scenarios, people aren't going to be doing that. But there are some who see this obviously as an opportunity. So look, those are really the headlines. Obviously early days, but far and away the biggest focus is on guidance. And I'll probably leave it at that, Leah.
I'd now like to turn to Sun Lu, our senior Asia macro strategist. Sun, thanks for joining us. Just to jump into it, I mean, how do you expect China to react to the sharp escalation of tariff tension, and what kind of stimulus may be announced as a result of this?
Yeah, sure. Thanks. So far, China has responded to the tariff escalation basically with tit for tat strategy. And right now, with the tariff level against U.S. already at 125%, further escalation on that number already does not bear any economic meaning anymore. So I think from here, we need to look at whether there will be a phone call between the two leaders, which may lead to some kind of a truce or further escalation. However, the actual trade talk between the two countries may take time, given the U.S. side is very much focusing on negotiating with the other trading partners, in particular allies. And for China's side, it may also be better to wait for the U.S. data to weaken in the next few months to gain better competitive grounds in terms of bargaining power. So I think, we may live with moderately high tariff or this very high tariff for a while, and we've seen Chinese policymakers sounding they're very prepared to deal with this growth shock with additional stimulus. Now, our GR does estimate that with this over 100% tariff on China, the growth hit is going to be over 2%. So in terms of what could be announced, we think it will be mainly in three areas: monetary policy, stock market support, and consumption support. So I think we could see triple R cut, rate cuts pretty soon. And stock markets, we could see even monetized stock market support. The PBOC, for example, has mentioned they will increase relending facility to the national team for them to support the stock market. And we can also perhaps see the detail of the stock market stabilization fund that was mentioned by policymakers before. Consumption is a big focus, and I think it will be definitely something the market is very keenly waiting for. We think there are a few areas that they can do. For example, increase the scale of consumer goods trading program, consumption voucher, and release details of the birth subsidies. So I think these are the areas they're likely to come up with. Eventually, we think they will also increase the fiscal bond quota, but I think that could take time given we just approved the national budget last month, and most of those bonds are not issued yet. So I think on the fiscal side, it's probably going to be more focused on accelerating issuance and accelerating spending.
Thanks. And what are your thoughts on the RMB, Chinese rates, and equities amid these cross currents?
Yeah, sure. So on the renminbi side, our biggest conviction trade is short renminbi versus basket currencies, especially against euro and yen. So overall, with the tension escalation, we have seen China moving the midpoint fixing above 7.2 for the first time since 2023. We think that shows that China is ready to allow moderate renminbi depreciation as they need to relax monetary conditions on all fronts. Now, that move is very gradual if you look at the pace of fixing move in the last few days, implying every month we're depreciating around 80 basis points against the dollar, as the PBOC don't want to cause any panic in the market and continue to support stock market sentiment and send goodwill to other trade partners who China want to expand trade relationship with. But with the broad dollar weakness, obviously we also seen volatility in dollar CNH. In reaction to that, we have seen PBOC fixing quite stable despite the large dollar weakness. That shows that China does not want to see a major renminbi appreciation against the dollar. So that leads up to renminbi have a lot of room to depreciate against non-dollar G10 currencies such as euro and yen. So we think that the renminbi depreciation against basket currency has a lot more room to go. For example, the official CFED basket, right now we're around 96. I think we can move to 90 in the next few months. And this can also help effectively offset some of the tariff impact on Chinese exports. On the renminbi level against the dollar, we think 7.5 level is likely tolerable by the authorities. Historically, every time renminbi is allowed to depreciate, it's roughly 2,000 pips compared to the previous weakest levels. So we think from the macro stability point of view, 7.5 is likely an acceptable target for PBOC. On rates and equities, we're bullish on Chinese rates. I think, given the huge growth hit and also the PBOC allowing currency start to move, we think rate cuts is likely to happen very soon. We think rates curve can rally another 20 basis points. We think the bond curve can boost steepen and liquidity may start to ease compared to the very tight liquidity condition we've seen earlier this year. Equities is more resilient than expected so far. That's due to the strong support of Chinese national team, and also the onshore retail sentiment on equities is not as bearish as one would have thought given the large tariff. So I think given the growth support policies likely to be released, and in particular stronger support from national team likely going forward, we think the dips in Chinese equities are likely to continue to be bought.
Thanks. And then final question for you. What are your broader thoughts on the Asian macro?
Yeah, sure. So we have seen Asia rates being the preferred place to express the current macro dynamics, which we think can continue to run. There are two things, right? First, the growth is getting hit given Asia is an export-oriented region and very sensitive to China growth as well. And second, inflation is coming down. Asia is very sensitive to oil prices. Oil coming, now lower to the lower end of recent years range is very helpful to Asia disinflation. And also, China may have to export their goods, divert them from U.S. to some of the Asian markets, which creates good supply. So I think receive Asia rates broadly make a lot of sense. Long bonds would particularly receive rates in Korea, in addition to China, and long bonds in places like India and Philippines. For Asia FX, we have seen an interesting turn in the past week with the tariff suspension on ex-China exporters. We have seen market unwinding some of the short position in Asia FX. Overall, with the weak dollar, with market repricing U.S. assets and diversifying away from U.S. assets, I do think the convexity for dollar Asia is to go lower, as Asia as a current account surplus region hold a lot of U.S. assets. And those overweights and unhedged position are yet to change. So I think, from a risk reward perspective, position perspective, I think the convex trade for dollar Asia is to go lower.
Great. We now have Filippo Taddei, our senior European economist, joining us. Filippo, thanks for being on. First question for you. We'd love to understand, what did you learn about the EU stance on U.S. tariffs from Commissioner Sachs' press conference on the 7th of April to President von der Leyen's announcement on the 10th of April? We've obviously heard different things throughout. Love to get your take on that. And what are your assumptions on how the EU will retaliate against U.S. tariffs?
Thanks, Leah. And I think we learned at least three elements here. First is that the EU is more cautious than the initial communication in the aftermath of the first tariff on steel and aluminum suggested. If you go back in time for a bit, initially the EU Trade Commissioner Šefčovič emphasized that while negotiations or finding a deal was always the preferred option, all countermeasures remained on the table, including tariff on services from the EU side. Then we learn on the following day, after the US administration decided to pause the regional component of the reciprocal tariff, so the add-on on top of the 10%, the president of the EU Commission also announced that the EU would pause its initial retaliatory tariff on steel and aluminum, and that were approved just on the day before. So a meaningful reversal there. The second element that we learn is that the EU is really trying, and this is not just posturing from our point of view, all it can to avoid the tariff retaliation. We look at tariff retaliation as a self-defeating policy tool. I think that it's fair to say that is their intimate, their genuine conviction. And given the risk of escalation, as the relationship between China and the US showed, they really wanted to try to avoid, to stay away from that risk as much as they can. The third element that we learn is that we should not think that retaliation is not really on the table. So if negotiation between the EU and the US will deliver no result, no reversal, no policy reversal, at least in some shape or form, the EU will eventually implement a set of responses, including mostly tariff, possibly some other countermeasure, trade impediment that could extend also to non-traditional sector. The response will be backloaded. I think we got any sign, any possible evidence that this is unlikely to happen in the next 3 months for as long as the pause is in place. So it's more of a second half of the year issue, but it's going to come. It's going to come if there are no progresses there, if things stay as they currently are. So once we factor all of these elements together, this delivers, our baseline expectation is that if we wanted to be more specific about how the EU will respond to US tariff, I think we have to distinguish the response to product-specific tariff, like steel, aluminium, auto parts, potentially critical goods, where we think the response will be proportionate, but will be in value terms. So essentially by raising a similar tariff rate to the one that the US raised, let's say something around 25%, on an almost equivalent value of US exports into the EU. Maybe something less than equivalent, so always showing some leniency, or if you want, some constructive attitude. Instead, we expect that the response to the broad-based reciprocal tariff, so the current 10% that exists, when it comes, if it comes, and when it will come, will be through a general tariff, a lower tariff rate than the US, once again, on possibly a smaller value of US goods than the EU goods affected by the reciprocal tariff. So again, showing constructiveness, showing a will to negotiate even within the retaliation. The EU response, in a nutshell, will in our view, will be proportionate, backloaded, will be always lower than the US tariff. It's unlikely to happen in the next 3 months. It's backloaded once again, and what we think we should not entertain unless we are looking at a risk scenario is the possibility that this retaliation extends to tariff. We're getting many questions from clients on that, but I think we should treat tariff on U.S. services, on the imports of U.S. services, really as a risk scenario, as a tail option that will be triggered only if things slip out of control. If the negotiation fails, the retaliation kicks in, there is a retaliation over the retaliation, so the escalation into a trade war will leave the EU with no option but, extend its response into services. And the reason is a bit of in the numbers. The EU runs a pretty large surplus in goods, but a deficit that is about 150 billion in services, so with the US. So that is an obvious dimension of retaliation if things escalate. Again, not our baseline, but on the table.
Thank you. And just second question for you. Following the announced 90-day pause on the country-specific component of the reciprocal US tariff, could you update us on how you're thinking about the European outlook and how that has changed?
Compared to our previous baseline, the 90-day suspension of country-specific reciprocal tariff provided a welcome upside surprise. But most tariffs remained in place as in our baseline. If you think about the steel, an aluminium tariff, auto tariff, the global reciprocal tariff at 10%, they're all in place. In addition, we continue to expect a US tariff on critical goods to come online at a later date at a 25% rate. So, in addition, other factor, at least since our last revision on Friday, are providing more downside risk. The uncertainty around the trade outlook remains very high because country-specific reciprocal tariffs, sure, are not there, but have merely been postponed, not cancelled. In addition, the global growth outlook seems to be on the deteriorating path. US tariff on China have been raised to 145%. This is much higher than what was announced on April the 2nd. As a result, our China team downgraded the growth from 4.5 to 4% this year and down to 3.5 in 2026 for the China economy. If anything, the higher tariff in China are also pointing toward more trade diversion toward Europe, which could weigh more notably on inflation. In addition, the U.S. team now sees lower growth in the U.S. by another 50 basis points. And if things were to deteriorate further and the higher reciprocal tariff were to be implemented, the hit on U.S. GDP would be higher. But these are not the only factors that are weighing on the European outlook, providing a downside risk. Financial condition also remains significantly tighter after the post-pause market rebound, 30 basis points tighter than in our last forecast on April 4th, and 60 basis points if we compare to early March at the last meeting of the ECB. In addition, European currencies are materially stronger. The euro, on a trade-weighted basis, is up by 6% since early March. So all these factors together more than offset to the downside, I'm afraid, the positive surprise of the pause to reciprocal tariffs. And we decided to downgrade euro area real GDP by an additional 0.2. We're now at 0.7% for 2025 and 1% in 2026. Looking across Europe, the main downgrade, possibly not surprisingly, in terms of GDP at least, happens in Germany and in Italy, in our view. It's going to be less in France and Spain. If we combine with this view on growth with what's happening on the inflation front, I think it's notable to observe how energy prices have fallen, how sharply they've fallen, and they've not meaningfully recovered even after the announcement of the 90 days pause. So as a result, the euro area energy price index is now down additionally since our last forecast, and again, some 15% since early March. So if you combine all these factors together, pointing to lower growth, more significant downside pressure to inflation, and you add to these factors also the delayed retaliation by the EU, which was a response to the pause that the US tariff that the US administration pause determined. We get a sense that the ECB will take account of this, and we've decided to add another cut to our forecast. So we're now looking at 4 25 basis point cuts in the next 4 meetings, so back to back, starting from April and going all the way until September included, for a terminal rate at 1.5%.
Thanks very much. I'm now going to hand the call back to Mark.
Great, thank you very much. Now going to the US, and we're going to start with Alec Phillips, our chief US political economist. Alec, do we have clarity on tariff policy now, or do you think there are further iterations of the market stress to come? And how should we calibrate the risk of, or the timing and risk of, China headlines?
Right. So I think we now know where the floor is and where the ceiling is in terms of tariff rates. Of course, the challenge is that the ceiling is quite a bit higher for some countries, and so that starts to get into sort of nonlinear issues around the impact of tariffs. I'd say from here the main questions will be, of course, number one, how many of these countries can actually negotiate deals with the Trump administration over the next 90 days. It's pretty clear that negotiating comprehensive trade deals, is going to be extremely difficult during that short window. If you think about the fact that the USMCA negotiations, for example, during the first Trump administration took 2 years, it's just going to be extremely difficult to negotiate deals with all of these different countries. And so I think the question will be, can we see some announcements around, for example, purchase agreements or things like that announced to at least push the tariff risk back? And then the other, sort of general thing would be on the sectoral tariffs. So while we have all been focused on these broad-based tariffs, there is still, I think, a pretty high probability that we will get some of the sectoral tariffs announced. Pharma seems to be the next one coming up, and pharma imports into the U.S. are worth almost 1% of GDP. So that could be a meaningful tariff on its own. And then beyond that, you have semiconductors and electronic components, critical minerals, et cetera, et cetera. And so when we do the math on those sectoral tariffs, that's worth around 3 percentage points altogether in terms of things that have been announced or are very clearly expected, but have not yet been implemented yet. And so, to put that in perspective, the overall liberation tariffs, if you want to call them that, that were paused this week would have been worth about 7 percentage points. China was around 2.5 points of that. So, the remainder was, call it 4.5 points, something like that. And the sectoral tariffs are actually worth 3 points. So it's not quite as much, but it's on sort of the same general scale. So I think, the real question will be from here, do you end up seeing Trump bring back the sort of the more explicit threat of applying some of those country-specific rates as we get closer to the end of the 90-day period, simply because I think a lot of trading partners will recognize that 10% across the board baseline tariff seems, very unlikely to come off for most countries. And so what exactly are they going to get if they do a deal? And the answer presumably is that they will get a further reprieve from those country-specific rates. But in order to convince them, presumably those country-specific rates are going to have to still look like a real threat at the end of 90 days. So I think the general message here is that while we have a reprieve, it would not be at all surprising to see the threat of those tariffs at the end of 90 days look a little more real than maybe people are treating them today.
Thanks, Alec. And in a similar vein, what are the key events, milestones, data points that you think investors should be watching most closely as we go forward from here?
Well, I mean, one actually, which you had asked about before, would be with regard to China specifically. And so there, the tariffs that took effect this week don't actually apply to shipments on the water at the time that the tariffs were implemented. And so that means that for the next few weeks, you'll have shipments arriving into the U.S. That still are pre-tariff. And once those shipments have arrived, then I think the question will be, do you basically just turn off trade with China? And presumably for many imports, that's what's going to happen. One would imagine that there will be some very specialized products where U.S. companies have no choice but to import those, maybe because they're going into U.S. production or something else. And so I think we'll reach a point kind of later this month where you start to see just essentially a substantial decline in imports from China arriving into the U.S. and presumably then some disruption in terms of, U.S. production because of that. And the question will be from there, how long does the Trump administration allow that to happen before trying to do some kind of a deal? It's hard to know. I would think, at least a few weeks and possibly more than that. And our general assumption has been that these extra China tariffs last through May, but that's, just a guess at this point. And then outside of that, I guess, I would say the other kind of clear question is, as I mentioned before, is just how long does it take for Trump to bring back up the more explicit threat of some of these country-specific tariffs. And I would think that as we approach that 90-day deadline, and if you had to guess, you'd say maybe once you're a month out from that 90 days and you haven't seen a lot of deals inked, that we start to see some rhetoric around that again. So my sense is that through April, there's no real reason to expect big announcements, but that once we get into May, you could start to see some of these risks emerge. And then the only other thing I'll say, just in terms of the timeline in general, is there has been a lot of focus on the relationship between tariffs and fiscal policy. Like, do we end up getting bigger tax cuts because of this? And we will probably see that process now start in earnest in Congress at the start of May, where we start to see details around the timing and composition of those tax cuts. And right now it doesn't look like it's going to reflect additional tariff revenues at all. But we'll have to see if that changes. And then actually, I'll mention one other thing very briefly, which is it's also likely that Congress, at least in the Senate, will end up having another vote and likely will vote to block the tariffs that have just been imposed. But for now, that looks like a symbolic measure simply because the House is probably not going to take it up and Trump would veto it anyway. So those are the sorts of things that we'd be looking for. But unfortunately, for most of these, there's no hard date to point out.
Thanks, Alec. And now going to bring in David Miracle, our chief US economist. David, where do your forecasts stand now after the latest tariff announcements?
Yeah, thanks, Mark. Even with the pulling back of the additional country-specific portion of the reciprocal tariff, we still have very large tariffs in place. I think it's becoming increasingly a little debatable about how much this will actually affect the effective tariff rate, because with such a huge differential between China and everyone else, there's likely to be a lot of rerouting, a lot of substitution, but it will be at least 15 percentage points when we get all of the tariffs that we expect to come into place. That will deliver a big boost, we think, to inflation. We have core PCE inflation peaking this year at 3.5%. We might very well see CPI inflation a little bit higher because the sell-off in the stock market will depress the financial services category of PCE inflation, offsetting a bit of the tariff effect. We also expect a large hit to GDP growth from the tariffs of about 1.75 percentage points. So we have lowered our 2025 Q4 GDP growth forecast to 0.5%. And that's below our estimate of potential growth. So we expect the unemployment rate to crawl up a bit over 0.5 percentage point. And consistent with that very low growth path and some of the uncertainty around the effects of tariffs through, say, financial channels and uncertainty channels, and just the uncertainty about whether or not those additional country-specific tariffs are really gone for good or coming back, we have a quite high 45% probability of recession. We had briefly raised that to 60%, making recession our base case when it looked like, well, when for 13 hours the additional country-specific tariffs were in effect. About half an hour after we published that, those additional country-specific tariffs were reversed. And so now we think we are a little bit below the bar for recession, in part because those country-specific tariffs would have meant a meaningful further increase in the effective tariff rate, in part because they would have made evasion of the China tariffs more difficult, because many of the countries through which goods are sent would have also faced extremely high tariffs in the 40s. And in part because I think a kind of maximally aggressive approach by the US would have probably triggered more aggressive foreign retaliation. So this has taken us back below the bar, but at 45%, we still have a quite high probability of recession. I think the economic scenario that I've laid out for you would probably be commensurate with 3 25 basis point insurance cuts, kind of what has become the somewhat standard package for the Fed, similar to what they did in 2019. In general, we think that with inflation high and inflation expectations high, the bar for the Fed to deliver insurance cuts will be higher than it was back then, but the risks are obviously much greater, and we are forecasting an economy that is much, much weaker than the one we had in 2019. We're penciling those in for June, July, and September. I think it's going to take a little bit of time before we see weak, hard economic data, and in particular, weak labor market data. We just got a payrolls report. The data for April are being collected now. It's not clear to me that things would be particularly dire in the labor market right now. That probably means you don't see a meaningful effect until the May data that we'll get in early June. So that's the thinking. In the meantime, for the next couple of months, the Fed's going to have to make a decision based on what they see from financial conditions and what they see from survey data, which have obviously not been great predictors over the last few years. We think June is most likely, but the way you could get to an earlier cut would be probably most likely if financial markets took it a lot harder than they have so far.
And David, can you just run us through a little bit, how do you estimate the impact of the tariffs on the economy? And I ask that with a particular lens on the uncertainty effect, given that we now have this 90-day moratorium and a significant uncertainty about actually what comes into effect at the end of that.
Yeah, absolutely. We break this down into 5 channels. The one positive channel, the one positive effect of tariffs on GDP that we're penciling in is a small narrowing of the trade deficit. The U.S. has a large trade deficit. We now have very high tariffs that are likely to press imports. I think we'll get a small boost to GDP from that. Only small, in part because other countries will impose and have imposed retaliatory tariffs. So there is very likely to be a decline in exports as well as a decline in imports. And because I wouldn't expect too much in the way of reshoring. If you're not already producing in the US, it's probably because it's not cost competitive. And if you're only cost competitive with tariffs, probably are not going to undertake big new investments unless you're confident that the tariffs will be in place for a long time. And I think that recent volatility has made it hard to have that confidence. So not much of a narrowing of the trade deficit, but a bit. That's the one positive effect. On the negative side, I would highlight 4 channels. The first, the most concrete, most straightforward, the one that scales the most linearly with the tariffs, is that tariffs function like a sales tax hike. Some of the cost will be borne by the consumer. That will be a hit to real disposable income, and in turn, a hit to consumer spending. My guess is that the White House envisions offsetting that by using some of the tariff revenue for further tax cuts. So far, it doesn't really look like the fiscal debate is increasing the intended size, that Congress is increasing the intended size of the tax cuts in response to expectations of tariff revenues. So we're doubtful that the tariff revenues really will be recycled quickly into a tax cut. And that means that the tariffs will function like a tax hike. Second negative effect, in addition to government-led retaliation in the form of retaliatory tariffs against U.S. exports, we're also seeing some consumer-led retaliation. We're seeing some modest boycotts of U.S. products, cars, alcohol in Canada, for example. And then we are also seeing a big dip in tourist inflows into the U.S., in particular from Europe and Canada. So all of that will deliver an additional hit to consumer spending above and beyond, and to U.S. exports above and beyond the hit from U.S. consumers having a little bit less buying power. The final 2 effects of tariffs, final 2 negative effects, are a little bit harder to quantify, a little bit less predictable in advance. The third effect is the negative effect via financial conditions. And I think what we've seen so far over the first couple of months, contrasting that with what happened in 2019, is a good demonstration of how variable and unpredictable and dependent on market psychology all of this is. In particular, the equity market sell-off is now comparable to what it was in 2019 around tariff announcements, even though the tariffs look likely to be at least 10 times as big. So that's one to keep an eye on. We have not probably gotten all of the foreign retaliation yet. If we do get that, markets might have to kind of come to grips with that as well. So far, that effect has been meaningful, but pretty tame relative to what we saw last time. But that's changed a lot over recent days. And then fourth and finally, the effect of uncertainty on business investment. This, I think, will be a much bigger deal than it turned out to be in 2019, in part because measures of policy uncertainty have far surpassed levels that we saw during the first Trump administration, and in part because far more US businesses should be affected by tariffs and retaliatory tariffs that now cover the bulk of the world. In 2019, this was largely a US-China bilateral dispute. China's retaliation was largely confined to agriculture. Not that many companies in the US were affected. I think that won't be true this time around. We use a statistical model to try to account for the effects of financial conditions and uncertainty simultaneously. I think the two are inevitably intertwined, but the punchline is we have cut 5 percentage points from our capital spending forecast over the next year, reflecting the hit from tighter financial conditions and greater uncertainty.
And David, as if there wasn't enough complexity trying to navigate the tariff issue, there's obviously significant new policies at play also. Are you seeing any other risks or making changes related to shift in immigration policy and or fiscal policy impact?
You know, in our 2025 outlook, we highlighted 3 areas of policy under the new administration to keep an eye on: trade policy, immigration policy, and fiscal policy. We didn't expect at the time extreme outcomes on any of them. We've clearly gotten a pretty extreme outcome on trade policy. But from the limited amount of data that we have so far, it looks like the most extreme risk scenarios are probably not playing out on immigration and fiscal policy. So on immigration policy, net immigrant inflows into the US are certainly down quite dramatically. They peaked in late 2023. They fell extremely quickly in Biden's last year. They also fell very quickly in Trump's first few months. We expect immigrant inflows to stabilize at around 500,000 a year versus 1 million a year pre-pandemic. That, of course, would mean lower potential job and GDP growth. But the risk scenario that we've had a close eye on there was one where maybe the many millions of unauthorized immigrants already in the US working, especially concentrated in a handful of industries, might be afraid to go to work because of some of the worksite raids and other developments we've seen. There is a lot of anecdotal evidence of that you read in the US media. So far, we've not seen it in a big way in the labor market statistics. On fiscal policy, we expect the DOGE spending cuts to lower federal employment by something like 25 to 30,000 jobs a month. There, the risk scenario that we had envisioned was one where hospitals, schools, universities, state and local government agencies, scientific research areas that rely on at least a little bit of federal funding might all worry that their funding was going to be cut off. And even if the DOGE cuts don't wind up amounting to a huge amount, that uncertainty could have led to a hiring freeze. Again, a lot of anecdotal evidence of that in the US these days, universities, hospitals, and so on announcing hiring freezes. But through the February and March payrolls data, it doesn't really look like we've seen meaningful effects at the macro level. So I think the punchline here is the growth effects from policy look like they will be overwhelmingly dominated by trade, a much worse scenario than what we had envisioned as even the risk case. A few months back, we thought of the 10% universal as kind of the worst case scenario. We are well beyond that. But on immigration and fiscal policy, it looks like there will be some effect, but we've avoided the risk cases.
Thank you. Okay, we're going to bring in Peter Oppenheimer, our Chief Global Equity Strategist now. Peter, prior to the very big move up on the announcement of the 90-day delay to the implementation of the reciprocal tariffs, most equity markets had entered or were on the cusp of entering a bear market. What can we expect now? Equities are going to be living through a 90-day tariff-induced period of uncertainty. Do you expect a further bear market from here? And I know you've done a lot of work in terms of categorizing the nature of bear markets. How would you categorize this one?
Yeah, thanks, Mark, and hi, everyone. Yeah, I think the first thing to say is, yes, we are, in my view, in a bear market. We really hit that definition if it's broadly accepted to be, falls of 20% in equity markets. But of course, not all bear markets are alike. For those who are interested, we put out a report earlier this week called Bear Market Anatomy, the Path and Shape of the Bear Market. As you say, from the work that I've done historically, looking at bear markets over 2 centuries, you can broadly categorize them into 3 types. Of course, not all bear markets are the same. They don't all have the same triggers or profiles, but there are sort of similar characteristics. The first I would call structural, the second cyclical, and the third event-driven. The structural ones are the most severe, but fortunately the least frequent. And these are really preceded by a significant build-up in private sector imbalances and usually private sector debt, financial bubbles. And when they burst, often because of rising rates, they are manifest in problems in usually the real estate market and the banking sector. And that results in a deeper and deeper recession. And it's very difficult to get out of them. The cyclical ones are the most common, and they're really triggered by economic cycles and impending recessions and expectations that profits will fall. And the third type, the event-driven ones, as the word suggests, are really about one-off exogenous shocks of some kind or another that really knocks a cycle off course. Maybe a war or a commodity shock, for example. In some ways, you could say that COVID was a very unusual example of an event-driven bear market. Of course, these things are much easier to define and recognize in retrospect than in real time. And it is true that many event-driven bear markets morph into cyclical ones because the event itself, if it's prolonged, can force a recession, and therefore you end up in a cyclical bear market. And I would say, Mark, we're in between an event and a cyclical bear market. Now, what does this all sort of mean for market profiles? Well, if you look at the averages, and there's quite a lot of consistency when we look at it historically, the structural bear markets are very severe. Typically, you're seeing equity prices fall from peak to trough by about 60%. And this takes place usually over a period of about 3 years. And because they're so deep, it takes typically up to a decade in nominal terms to get back to the starting point. The cyclical and event-driven ones are actually very similar in magnitude. On average, they're both seeing falls of around about 30%. The difference really is in the length of time it takes. The cyclical ones typically from peak to trough are a year or a year and a half, and it takes around 3 years or so, sometimes a bit more, to get back to where you started. Whereas the event-driven ones are over much more quickly. The peak to trough is usually just a few months, and then you're back again within a year. So that's a sort of very brief summary of what we sort of recognized in the past. And I would say we're sort of between these event and cyclical type of bear markets. I don't think this is over. Of course, we did see a very strong rebound as some of the worst tariff announcements were reversed. But I would also say that bear market rallies are a feature of bear markets. And when you look at all of the major bear markets, they've all experienced strong rallies within them, typically averaging around 12 or 13%. And, on average, they take place over a month or so, sometimes a lot shorter. But, I think what we've seen is a rally. We may get other ones as news flow emerges. But I think the conditions to reach a trough in equities are not yet being reached. And just briefly, I think on that point, I would say that when we look at history, there are 4 things that typically coincide to build a sort of base in equity markets. The first of which is that valuations need to get attractive, and I don't think we've reached that point yet. It's true that the US has derated quite a bit, but it's still on most measures, into the sort of 80th percentile of long-term valuations. Equity risk premia is still very low relative to, when you compare to bonds. The second thing is extreme positioning, with lots of different ways of measuring that. But on our risk appetite indicator, for example, which is a sort of 20 or more risk premia, we're not yet at very extreme levels, although things have shifted more rapidly in that direction. The third is policy support. We haven't yet seen that coming through. Interest rate cuts, for example, would be one of, not the only, but I think one of the mechanisms that could help to build a base. But of course, as we heard from Fed a week or so ago, they're not in any urgent rush to cut rates. And of course, they're somewhat conflicted because tariffs themselves are inflationary. So I think we need to see more progress in that direction. And then finally, equities, of course, move to anticipate the future. And bull markets start usually in recessions when the news is very bad. But when the second derivative starts to improve, when the rate of deterioration in profits and growth starts to stabilize, and we're not there yet either. So a long answer, sorry, but I think I would categorize what we're in as a somewhere between an event and a cyclical driven bear market. That would suggest we're not at the trough and we haven't yet hit the typical conditions which would suggest a sustained recovery is yet imminent.
Very helpful. Thanks, Peter. One follow-up point. We've obviously been in a very long period of US outperformance and quite extreme outperformance of the tech sector. Since this correction began, really since the beginning of the year, both the US and tech have been notable underperformers. Given the situation we're in now, do you think, well, how would you be positioned relatively? And do you think the US and tech are likely to continue to underperform?
Yeah, well, of course, those 2 points are related. Actually, the period of significant outperformance of the US equity market compared to all other major equity markets didn't start last year when the term, when the sort of focus on US exceptionalism peaked. It's really been building since the financial crisis. And over that period of nearly 15 years, the US has gone through a sustained period of dramatic outperformance relative to the rest of the world. It was not irrational in the sense that most of that could be explained by much, much stronger profit growth in the US than was achieved in Europe or Asia or emerging markets. But a lot of that actually, Mark, has to do with technology. Technology is a much bigger part of the US market than many others. And of course, much of the success of the technology industry in generating much higher returns on investment margins and earnings than other industries also coincided with the period since the financial crisis. So a large part of the success of the US equity market relative to others over the last 15 years has been to do with the success of the technology sector and indeed the biggest companies. Now, we have argued for some time that investors should be looking at diversifying more because the US had become so big in the global market, technology had become so dominant, and of course the biggest stocks in the US had reached record concentration in that index, and that raised the risk in a risky asset. Diversification is a way of trying to moderate those risks, and it is beginning to pay off. I think that another part of this story is the dollar, because over that long period of time when the US has been outperforming, the dollar has generally been rising. US investors have had no real incentive to increase their exposure outside of the US, where there's less opportunity to experience growth and where currencies have moved against them. Whereas other investors, those in Europe, for example, have been highly incentivized to increase their exposure to the US to enjoy the benefits of a stronger dollar and also access this very strongly growing technology industry. But these two things are beginning to move in the opposite direction. And we believe that investors should continue to be more geographically balanced than they've tended to be over the last decade or so, because the prospective returns on investment and earnings are converging regionally more than we've seen for a very long time. Now, that being said, we also put out a paper out a week or so ago, a global strategy paper looking at technology, because it was, as you know, a quarter of a century since the peak of the technology bubble, and we wanted to just sort of examine the similarities and differences between the recent period of tech outperformance and what we saw a quarter of a century ago. And without dwelling on this in detail, what I would say is the major difference is that of valuation. So the really dominant companies in the US market in technology do have much lower relative valuations than we were seeing back then or in other bubble periods. So, for example, the biggest tech stocks generally have a forward PE multiple, let's say on a 2-year forward basis, to avoid 1-year distortions, of sort of lowish 20s, EV to sales of sort of 4.5-ish. That's roughly half the equivalent valuations we were seeing of the dominant 7 tech stocks, for example, in 2000. It's less than half the 7 dominant companies we were seeing in Japan at the peak of its bubble in the late 1980s, or even in the Nifty 50 bubble. So these stocks are not as expensive. They've also got very strong balance sheets and very cash generative. And because they actually have underperformed a lot, and they have strong balance sheets, they're probably somewhat more defensive. So I do think we're going to see convergence of geographical returns, and that supports our long-held view of increasing geographical and sector and factor diversification. But I do think also large cap technology is not going to continue to significantly underperform, and will provide some defensive qualities. And over the medium to longer run, is still going to be a very important driver of growth within equity markets overall.
Great. Thank you very much, Peter, as always. We're going to bring in our last speaker. Rich Pravorovsky runs European equity trading for us. Rich, it's obviously been a highly volatile week in markets. First of all, can you just talk us through what flows have been like, what franchise flows we've seen, and give us some flavor for client activity through the week?
Yeah, sure. Happy to, Mark. Look, I think heading into Liberation Day, we know people have been light and de-risking, and I think that's only really accelerated post. If you look at our franchise, we had record net selling in the week prior on Thursday and Friday in global equities. And I think that the stat from our PB was that the fundamental long-short net leverage in the U.S. was basically at 5-year lows. And then obviously through the week, we had what felt like almost a crash on the European Open on Monday morning, with some stocks down 20 or 30%. I would say flows felt a little bit more constructive, with some interest of clients stepping in. And then as the day progressed, through the session on Monday, we saw a little bit more interest. And then certainly it felt as if there was some optimism that there would be delay, which didn't manifest. And then obviously the big headlines on Wednesday. Wednesday ended up being essentially the largest notional buying in more than 10 years that we've seen across our franchise. And that was almost entirely driven by short covering in macro products. And I think if you look at the way things closed on Wednesday, you had a kind of levered acceleration from levered ETFs and kind of CTA demand that really exacerbated the move. And then Thursday kind of resulted in a lot of givebacks. So extreme volatility, clients chasing their tails. I would say as the dust settled towards the end of the week, and we did see hedge fund covering, but really the persistent feature has been long onlys still kind of steadily taking risk down, and I would say still pretty cautious view in terms of the overall outlook, but very erratic price action, and probably one of the most volatile periods I can recall, certainly in U.S. equity risk.
Yeah. That's certainly the case. And now, as we kind of go into the weekend and as we think about next week, what are you watching for most keenly, and what's your view, especially in terms of managing through this outsized volatility?
Look, I think there is, the glass half full interpretation, which is, from here on out, it's hard to get incremental bad news in terms of trade. We're likely to begin to see the outlines of deals for allies, particularly Japan, Israel, potentially South Korea, Taiwan, and get a sense of exactly what the off-ramps might look like. And so in a sense, it's hard to see where the incremental bad news comes from a trade perspective, and that might bring a little bit of relief. But I do think that the feedback from the franchise has been pretty persistently negative. And I would say as it regards to the S&P, we've kind of snapped recession on, recession off, but the probability is still kind of in that range around 45, 50%. And with the S&P at 19 times and an undiscounted, 275 EPS figure, there's just not a lot of margin of safety in the overall multiple. And my big takeaway from this week is that with an incredibly volatile policy agenda, the risk premium simply just needs to increase. And I think what you saw quite clearly was an exodus of capital from the U.S., whether it was U.S. stocks, U.S. bonds, or the dollar itself. Capital seems to be flowing out of the geography into other places. And again, given the multiple and the very low ERP, I think it's really hard to feel compelled that there's enough risk in the price given the lingering uncertainty. So I'm still kind of left feeling a little bit cautious on U.S. risk. I think, Europe can do better. I think it's a destination for capital. I think secular growth can outperform in an environment where at least front-end yields are compressing. Quality is the most persistent feature that performs very well in a recession-like environment in equities, and I think that will continue to relatively outperform. Obviously, we're kind of getting into the heart of earnings season now, and I think earnings are in a sense a little bit backward-looking, much like the hard data. But I think the market will be very, very focused on comments around exit rate, how current trading has been in the last few weeks, and whether corporates are seeing any signs of uncertainty cause deceleration across their franchises. But look, I think the volatility is going to remain a persistent feature. I fully acknowledge the market is extremely oversold, but I think we still got a bit more wood to chop before you're at a level where you think you've got sufficient valuation support to really feel that the bad news has been fully priced.
Rich, thank you very much. As hopefully is illustrated from all of our speaker lineup today, we are helping corporates, policymakers, market participants navigate through this as best we can. We look forward to being back again next weekend as we continue to navigate and dissect the increasingly volatile environment. But thank you very much for dialing in this weekend. Good luck in the markets this coming week, and we look forward to speaking again next weekend.